Okay, fine. So, shall we start with the meeting?
Yeah, that would be great. Thanks so much.
Or we need to wait for a minute?
No, please go ahead and start. We are already 5 minutes.
Okay. Give me a minute. Just I will close the door so that. Yeah. A very warm welcome to all the participants. Myself, CA Hemant Mehta, think tank multidisciplinary global platform chapter leader, welcomes you all to this think tank global conclave for India global story and the meet. The expert series covering in detail management think tank, valuation think tank, IBC think tank, financial reporting think tank, RERA cooperative society think tank, FAFT, ISA, IPO, and all the subject in the financial gametes, which has been covered in think tank session. As a major part of think tank at Vivek Patra, Vivek in Sanskrit means knowledge and wisdom. Patra is an innovative news updates containing the slides on sharing latest development and real life examples by CEO, CXO, CFO, with a very respected jury, CFO and panelists and specialists sharing experience in real life example. Our panelists are financial leaders working in a reputed companies or profession since many years and have deep domain knowledge. Think tank platform now is a digital and has got overwhelming response globally on digital medium and expanding rapidly through LinkedIn, in Facebook, etc. Our participants and experts have rich experience in industry and profession who have done CPA, CA, CFA, CS, CMA, ISA, DISA, FRM, IFRS, BTech, master degree, PhD, etc. Professional degrees. They are sharing their experience and knowledge and wisdom, spreading as a reach out to the think tank. You can visit our website www.thinktank.co.in. Due to overwhelming response to our annual report, corporate strategy and ESG, we have announced 6P awards and recognitions. 6P stand for profit, people, planet, professionals, promoters, and platform. For corporate annual reports, analysts, professional achievers, CEO, CXO, CFO, with a very respected jury with rich experience in interaction with the stakeholders and boards. This recognition and awards would be announced with a religious process of scrutiny and choice and interaction with the participants. As a participant, you are aware, recently we have already launched a much awaited referencer approximately titled as Think Tank at the rate Vivek Patra India Growth Story, a comprehensive conference material compilation over 600 pages, sharing experience by CEO, CXO, CFO, specialist with latest development and series of blocking, regulatory fraud, financial reporting, Ind AS, IBC, taxation, digital, capital market, technical analysis, ISA, bank audit, corporate affairs. It would be available for subscription and any ethical contribution by Valuations, etc. We wish to, we will also be covering important and latest development as suggested by many participants in coming week. Example, valuation and financial modeling, health is well, cyber security, blockchain, MSME, latest regulations and developments in various important professional bodies and institutions, etc. We request you all to subscribe to Think Tank YouTube channel for watching summits, conclaves, webinars, and join, connect, and network on Think Tank webinars group on LinkedIn and Facebook pages, Telegram channels, specially created for suggestion of many participants and panelists. We once again welcome you all members and panel And I would especially thank to my colleague in the digital global team. Few of them are Anupam, Aditya, Ajay, Anurag, Archana, Ashwari, Dushyant, Mitesh, Mihir, Malvika, Manish, Nipun, Pramod, Praveen, Rakesh, Rucha, R. Kanan sir, then Santosh, Subrat, Snehal, Sandeep, Sanjeev, Umesh, Vijay, Vikas, Vikram, Yogesh, and others for regularly contributing to Think Tank. Today we have a special and excellent Think Tank multidisciplinary platform seminar, eminent stalwarts and specialists sharing their experiences and latest development. Let us have an interactive event. And with this initial remark, I just request Manoj ji to take the proceeding further. Manoj ji, over to you.
Thank you very much, Hemant bhai. It's indeed a pleasure and privilege for me to be with you all. It's a wonderful day and very good panel and very interesting topics taken up on the CFO, virtual CFO series, entrepreneurs, and also a very, very important topic on investments, AIF, that is alternate investment funds, PMS, mutual funds, direct investments, deep dive, interesting. In fact, the credit goes to Sanjay Gaggar, who has a rich experience as a CFO, virtual CFO. I think the topic of family enterprises and family business was suggested by him a few weeks back, and it was taken up and right in earnest by Falguni, and who was very worked hard in preparing a deep dive presentation on this topic. Sanjay, are you there with us?
Yeah.
Sanjay, with your video on, can I request you to share a few thoughts about this, and then I would request Umesh and Anil also to share a couple of words before Falguni starts presentation. Yeah, Sanjay.
Sure. Very good morning to everyone. It's great to see Saturday early morning as we begin our, the weekend, and good to see that we want to understand more about what we call the real challenges on the family side of the business. And I can tell you it's a 12-year journey as a CFO service provider. And what we are looking at the new generation now is that there is a lot change which has happened now in terms of looking at the functional expertise in terms of growing the business to a certain scale. And that change, which I am now witnessing post-COVID in a very rapid manner. In fact, the last 5-6 months, we have seen huge requirement for a kind of functional expertise, whether it's an HR, whether it's a finance, because every business is looking for a scale. And the challenge with the business, especially on the family side, is that you have a lack of management bandwidth and the lack of functional expertise. And that's a real key constraint which a lot of the businesses are facing today. And this is what we are now looking at, the transformation which we need to address on the finance side and as well as on the digital finance side, what I will call, because the finance has now taken a new shape in terms of digital finance. I mean, there's a whole range of automation which one need to do before you actually start adding input to the business side. So finance today has to address the digital finance side as well as the strategic, the growth part of the business. Once we start getting the right data, the right analytics, and the right story behind this data, that's very important for any CFO to communicate to the businesses today. And if you don't have that kind of an expertise, I don't think we can actually add value to the business on the family business side, because they are already having a lot of constraints. So CFOs need to articulate the thought process around these two critical inputs, the digital part of the business and how you can actually start adding the real business growth scale challenges and the right data behind each of the monthly inputs which we are getting from the management system or the reports. How you can communicate effectively to the business in terms of adding to those input in terms of the scale up. Yeah.
Thank you, Sanjay. In fact, as a part of the series, participants are also looking forward to a presentation by you, a deep dive, interactive presentation on virtual CFOs. Umesh?
Yes.
Yeah, some thoughts from you?
Yeah, definitely. Good morning to all of you, friends. That's very indeed a good pleasure to have interaction with you on the Saturday morning. And we have with a very stalwart lady who's going to take up the discussion about the family business and journey towards corporate growth. Last time we had a discussion, a very well discussion on the startup topics. And I think today's presentation will be really marvelous to have a lot of inputs from your side. Let me take you to the family business history. If you see the ancient history of the India, we had a system where each family used to conduct its own business and they are specialized in that business. But over a period of time, over years together, when the journey started, the transformation took place, the growth taken place, the economy is changing. We have seen certain family business could able to grow their business to a large size. If you can name few of them, or maybe Tata Birlas, or maybe Adani, or maybe these are these big corporate houses who had Bajaj, and so they have a good family background and they have good family corporate houses they have developed over a period of time. But if you see, this is not possible for every person. That is where the things we have to see how the family businesses can take up to this next level of corporate world. I think there is a business entrepreneurship requirement for any corporates to grow, and that could be at 1.1 level. But yes, you can be a first generation entrepreneur. How to scale up your business to next level to a corporate world, to make it a big scalable, or maybe in a bigger corporate entity as such, takes a hell lot of other things, other requirements. And as rightly said by Mr. Sanjay, it's not only the idea, not only the one man job. It's a teamwork, and definitely a team consists of management, and management comes with a lot of other areas. It's right from the objectives, then we have to set the aims and objectives of the organization. Then we start with HR, then management, people, profit, chartered of the organization, strategic discussions. N number of things takes place, n number of functions take place, and with those functions, the whole thing starts, and then we can able to scale up the business from the family businesses, a small size family business, to a corporate world, to a corporate entity as such, big corporate entity. And friends, it's not so easy. Yes, I know the requirement of money, the requirement of expertise, the functional expertise. Every person cannot be the CEO, CFO, and everything of one organization. No, it's not possible. You may manage it at a very initial stage when the scale is very small. You may be dealing with a few number of your clients. But as the business grows, you need to hire some of the specialists, some of the experts, without which things are not possible. And that is where we have to see how these family businesses can be taken to the corporate level. And I think today's presentation will take you through what are the various requirements, what are the hindrances in scaling up these family small businesses to a big corporates. Could be an issue, could be of finance, it could be of management, it could be of functionalities, expert functionalities, so many things. But yes, as a business entrepreneur, the always aim of any business entrepreneur is to scale up, to grow, to increase to a sizable extent, to reaches to the masses. Then only you can able to bring a sizable amount of profits or sizable amount of wealth to the organization. And that is possible only when you can able to scale up to the large extent or to the corporate world. And I think today Madam Falguni will take up to all these things, how the challenges to be faced, how these challenges will be met by the experts guidance of the advisors, or maybe the people who are across the business world. And I think we'll be have a very excellent discussion in coming 1 hour time from the madam. With these initial remarks, I really welcome all the participants and the panelists as well as the speaker for the day. Thank you very much. Thank you, Manoj. Over to you.
Thanks, Umesh. Anil? Anil, you are there?
Hi, can I say something?
Who is this?
My name is Vishal Jaswal.
Yeah, just put on your video because we have a formal program. You can just put on your videos and Falguni is ready to start a presentation. In fact, you can come in later after the presentation is done.
Okay, not an issue at all. Not an issue.
Right?
No, absolutely fine, sir. Absolutely.
Yeah, be there and there is a presentation. Then lot of then you can come in. Yeah, Falguni.
Very good morning to everyone.
Yeah, it's a delight to have you once again as a part of the series.
Thank you. Thank you so much.
I would just say at the beginning of the stage, family business, ultimately families get together, they start business. And in US, they often call it mom and pop business. And they grow because they need more hands to join in and more capital, more management, more employees. It gets. And as family business grows, as is human nature, there is greed. And with the greed, there are disputes and there is conflicts. And then conflicts needs to be resolved. We have lots of examples. We would see the mainline papers, the biggest groups. Some have stayed united and consolidated and growing. But many at various stages, there are disputes, whether it is Singhanias or it is Ambani's. And then you require well-wishers and professionals acceptable to both to do mediation, arbitration, or just well-wishers, or call it a truce. So it's a big, bad world of business. Professionals have a lot of role to play and enabling growth, digital and success, and ultimately take India growth story forward. Yeah, so we look forward to a deep dive interactive session on the business and then deep dive into much larger world of investments were run by businesses and many are family businesses, family promoters. Falguni, a few words about yourself you can just mention. And everybody knows you are a professional and you are an eminent speaker and board level experience with businesses as varied from jewelry to distilleries to gaming to entertainment and what's not.
Thank you. Thank you, Manojji. Very good morning to everybody and thank you for joining in on this Saturday morning. Spending time to hear us on the deep dive of family businesses. And something about me, I will be in short because I know you all are waiting for the seminar to start. So I've been a professional chartered accountant by profession and have also done my computer programming. Been working in industries for last 25 years and have now taken up an entrepreneurship plunge and I'm into CFO advisory. IX CFO is a platform which is into CFO advisory services since more than a decade now. And Pan India, we have done more than 200 mandates. And this is where I am. And today, let me start on the topic. Friends, as you all are aware, family businesses are, 90% of the Indian business economy is consisting of family businesses. You call it the Tatas, you call it the Birlas, you call it Reliance, Ambani, they are all family businesses. But since our series is on the SMEs and startups and, targeting those audiences, I would like to present you all the professional family businesses, which are not of Tatas and Ambanis, and I have tried to keep my presentation very, very simple, in a very simple form, so that I'm able to at least, if at the end of the day you're able to take 2 or 3 points and able to actually implement them in your real life scenario of businesses. So I have ensured that the presentation is in a very simple language. After my presentation, please feel free to ask questions and I would be happy to address them. Yes, so family business success. It's all about people, right? What do we say? How do you define a family? A family is a set of people in the same family, maybe in the same family tree. It can be a single family, or it can be a joint family, or it can be a bunch of family members putting together. So what we have seen, the trend is now going around. One second. So are you able to see my screen correctly? Okay. This jump shift of the first time entrepreneurs has just prompted much soul change in many of Indians' traditional family-owned managed businesses, who have had generation or two presence in the Indian market, and the younger generation within these family businesses are now many from B school. So educations and looking at these startups, their question is coming in their mind that have we missed the bus? Because the next generation is all they are from the B school now. So they are wondering whether they have really missed the bus. So India has historically had a glorious business track along with enterprise building as well as trading strength. Much of the business ownership has always resided with families, and that trend still continues. But however, there has been a disruption with a lot of new startup owners, entrepreneurs who are non-business, from business background, have started businesses, and they have accumulated a huge attention of not only consumers but also of the investors. So what is important in business? When your next generation is now in business, what is the challenges? What is it? Is the most important thing is how do you engage the family in a family business? That's the most important point that one needs to ponder. So engaging is a key to keeping up the interest of the next generation and family members in the business and achieving the desired results of progressing the company. Engaging typically used to happen on lunch or dinner tables. We all know that typically it was happening on lunch and dinner tables. But due to the complexity and speed in the environment in which the business is, it is imperative now to establish formal communication channels even with your business family members. When you're talking about business, you need to create formal communication channels. And, it is imperative now to establish family members and include new family leadership teams where required. Keep your processes simple. What is the key thing which I have noted down in the most of the entrepreneurs? They have everything in the mind. They say that, we are very well established. We are more than 50 years old. My father was doing the same business I am doing now. My next generation is doing, but so much only in the mind. So once if you are not putting it in writing, if you are not penning it down of what is your vision of the family values, what are your core own business values, then the next generation, it will be very easy for the next generation to relate themselves when they see, if there is something in writing, it even affects the people around you who are working in a very clear strategy of where the company is. So it is time now to pen it down of what your values are, what your business values are, whether they are, how the family values and business values are merging. What is your vision and mission? So pen it down. Pen down all the processes, systems, and what are your expectations, key performance areas, including in family governance. One very important thing is that pen down even what are your roles and responsibilities as family members in the company. That will give a very, very clear vision to the family members. They will feel more engaged because they know at the end of the day what is their responsibility, what is their authority, and how they will be able to contribute to the business. So pen it down. Also, you can understand that change is inevitable. So do not shy away from any 360-degree change in the business. And continuous clear communication can only give you trust and transparency, because you all know now that family businesses also are now open in the market for competition. There are, fundings available to companies who are able to sell themselves in terms of transparency, trust, and scalability. So you are now in the market. Earlier, family businesses used to operate in a very different manner, and funds were available to them in a lot of different streams. But now they are in competition with a lot of other startup companies and other entrepreneurs. So they have to build up the trust and transparency by keeping their processes written down, simple, and continuous communication of what they are wanting to do. I think that continuous communication and clear communication will get the transparency. When I say communication, it can be also, formal communications from time to time. So simplify your business processes and accounting. One more very important thing I'm finding in the entrepreneurs who are going through with generations is that somehow, their accounting systems are very, very complicated. I mean, they have created this complication by thinking that, others would not understand. But now it is happening that it's becoming a very big headache for the new generation people to handle this business and to scale it up to the next level. So you need to keep your accounting processes very, very simple. You need to simplify them as much as possible and use digital wherever required, even to communicate with your customers, even to communicate, online digitally with your consumers online. Then formal opportunities for members to connect for discussions. As I told you, you have to have a professionalism within your company also. Professionalism means that, you have there is somebody to take a decision when you are in the office. If two members are involved in a decision making, if either one of them are allowed, at least the continuity of the business is going on. So some kind of professionalism of, processes within the family members also are very important. And once all this is clear, the engaging of the family in a family business would be more better. So how has been the journey of the business in India? As I mentioned to you, globally also family businesses contribute a very large part of the economy. And in India also, it's more than 85% of the businesses in the economy contribute from the family businesses. So how earlier the journey was that pre-1991 liberalization, there was a license Raj. So the business owners had built capabilities and network around this rule. So they were flourishing and they were very happy around the business license Raj. But 1991 post-liberalization, the Indian family businesses were faced a new environment and serious challenges. Okay, and those business owners who were proactive and flexible were able to survive, and the remaining they could survive and they could go to the new business environment. And much of the license Raj businesses who were not able to be flexible had to shut shops. Then in 2015, we saw a complete new age digital companies, e-commerce. And we saw that, the way things were changing, the consumer behaviors were changing. And businesses had to relook business models. The businessmen had to relook at the business models, stay relevant with the changing demographics and consumer behavior with internet penetration growing fast. So what was happening was how demographics of a consumer were changing, because the new generation were now going to be your users. So with internet coming in and with digital companies coming in, a lot of things were changing very drastically. And post-COVID 2020, the new age digital companies, the e-commerce led came into, a very high speed up we are seeing, and the valuations have overshot the traditional businesses. Why? Because the investors see future potential and perception of, those businesses. It is now a desire to do moment for traditional businesses which are on threshold of higher scale or consumer velocity. But now what is happening is that post-COVID, the digitalization has grown to another next level. Okay, your consumers have changed. Your journey, your change management journey has to begin very quickly. And obviously followed through Can somebody mute because it's noise is coming? Can everybody mute their phone? So a key theme that has emerged in India's startup ecosystem or rather landscape, onset of pandemic has been that it has significant digital acceleration.
Requesting
Can we
Krishna
mute?
kindly to mute the
And
Krishna Nair, kindly mute yourself. Krishna Nair.
thank you, Suresh. That was really helpful. Thank you. So the fintech and e-commerce have continued to gain importance, but that's not it. The consumers are changing. So who are your consumers? Your consumers may not be the same what you were right now, because you know the B2B businesses are going to D2C. So you know, what are your distribution channels? They also may are changing so fast with digitalization. And post-COVID 2020, the new era of disruption really made people look at business formats one thing. So the consumer needs are changing. The consumer behaviors are changing. Your must-have, need to have, and good to have. You need to very, very clearly categorize your business into that. And the businesses who are really able to look at them in this challenge situation in a disruptive manner are the people who will, flourish and, do very well in this new economy. So what we are talking about is when your next generation is joining the family business, what is very, very important is to articulate the vision and mission of the business and the family values in writing. As I said, it would be very important. So what are your core values? What is your vision? Does each family member see himself in 5 years? Where do they see themselves? Document a succession plan. So as a last, what you need to do is you need to have a family ownership structure very well defined. Certain times family structures are very complicated. Everything is in the mind, as I told you. So, what are the shareholding structures? Even though if it is only in your family, you chart it down as to what is the ownership structure, how do they fit in the business, how much of the part of the owners are actually doing the operating the business. Define it with pictures, charts, and family tree, partnership matrix. If you are in partnership, it will be very important for your next generation to understand that what is the ownership, what is the decision making, what is how they are going to be relating themselves to this business. Also, governance is very important, because when we say family businesses, then the outside world, the capital market where you want to target and now go into competition, get funds in a very economical way. So governance is one very important topic where family businesses people want to look at in a little different way. So what is governance? Governance is a set of framework which helps you to communicate with the outside world and even with your own family members. So I would say family governance is very important because family governance will then define your corporate governance. So, it's very important to be having a framework of rules, who will take the authority of, signing, who will be authority to take decisions, who will be the approver, who will be the supporter. So that kind of matrix, if you put it inside, that will be your family governance. A lot of things in family governance is, applicable of what are their rights, how they would be able to benefit, what would be their ownership structure. So family governance has a lot of other things. And then you have corporate governance. So, you are operating within the environment, sustainability, and growth. So governance is the, in the framework of ESG. It's very, very important nowadays, that whether you are having a proper governance in place or not. Are you able to clearly communicate transparently in terms of your financials, or in terms of your business line, or in terms of your communication otherwise? So I believe that governance is a very, very important, important for entrepreneurs if they want to be in the market for, because now the market is widely open for competition. So earlier, family businesses are having their own, sweet net. Now it is no longer that. So I think to rupture that, the entire disruption, governance is becoming more and more important. Conflict management policies. Again, in business, one of the challenges which we have seen is if the, family members are not, tally with each other, or maybe not convergent with each other's ideas, there is a very rift in the business, and the business can take a very different turn. This can happen anytime, even if the, maybe the successor of the business, or who is the, one level of generation is not there, and suddenly, you are met with other people of your siblings, and there is a conflict management happening. And because of this, many successful businesses are also seeing ruptures. And we are seeing that they are, in a very bad situation, not able to scale up their business the way they could have scaled up. So putting up a conflict management policy would be very, very critical. What is a framework? Put that in place. So that would help you to then resolve it in a very, very effective and timely manner. And you will be able to move on your business very well. This is also one of the conflict is also one of the areas of concern when investors are investing in family businesses. That, are there, what kind of investment board is that, and how is the relationship between, relation of actual working relation is also very, very important. How comfortable you all are with each other to work. And do you have a conflict management policy in place? So that investors are always looking out for. Then, as I told, organization chart. Now, this is one thing which I have with my personal experience of companies working in more than 100 years old company, whether it's in whichever field you say, I've seen that putting up an organization chart somehow, is not so simple for entrepreneurs. They are, so this, what does this reflect? There are organization charts, but then there are few flowing around in the company. They are not unanimous. There is no one complete chart in picture. So what is it that is holding them back with having a proper organization chart? Is that they are, the leadership team, who is at the top, who is going to manage that particular function. If there are more than one family members, whose name will come in the top. But I feel that it is very, very critical and key critical for organization chart to be very crystal clear, because that will help you all internally to also brainstorm and arrive at a very, very concise communication to your team members also. Okay, if you are not having enough, skill sets within your company, you can have leadership teams who are non-family members also in the organization chart, and then make the organization chart complete so that communication is very clear within your employees also, and whom they are reporting into also. Also, I'm feeling that, because there is no clear organization chart also, multiple reporting is okay. We are all used to in the dynamic world to report multiple bosses and all that. But however, very senior leadership people also I have seen struggling about non-performing. They are not able to perform because there are conflict of thoughts and the decisions, and they are reporting to more than one people in the family. So, this is a feedback right from very senior level people. So that's why I feel that the organization chart is something that will really crystal clear everything. The route should be, really laid out very well. So is your next generation feeling your business is uninteresting? So maybe, the right way of communication has not gone of what your business is, how it wants, how is, until you do not do all these basic things of putting things in picture of actual business in writing, your next generation will not be able to see what is the potential in future of maybe different streams coming out from the same business, or maybe scaling up the same business in a higher way. So in order to keep your next generation engaged, you need to really have, these kind of, clear vision and mission statements of your family values and business. Also your clear organization chart, a complete governance, whereby when in governance, communication also comes, that you have family governance means all the family members are well informed, they are well engaged in your business, they are knowing what are their responsibilities. So this all creates a sense of trust and prosperity of them seeing growing together with the business. So, also untapped woman power is there in the families. So I'm saying, now we are seeing more and more women resources also of the families getting used, and they are also being brought to the business and getting evolved. But what is important is also to provide them with, correct kind of data that they require to perform their role, and correct resources and training also necessary skills if they want to manage that functions. So the family needs to understand that even though they are family members, training on specific skills and upgrading themselves on the management, MIS and resources, I think would help them to then successfully contribute to the business. This is a structure which I have given. It's a very famous structure of ownership, family and business. So in ownership, where do you stand? Who are the third party investors? Who are your family members? Members who are actually in the business also and in the ownership also. There are some only in the business, not in the ownership. And then there are some who are in the ownership, but they are actually not doing the business. And there are some family members who are neither in ownership nor business. So I think this helps us to find out who are in the family, who are the extended family, whether there are siblings, spouse or in-laws, several cousins are there, others are there, one dominant owner is there. So, I think this having family trees, family structures, understanding them and putting them in this perspective will give the next generation a very big clarity, and also they would know where their business is headed, where they are headed in their business, and how they can take this up. So what we are seeing is that a document, what you need to do is that, as I mentioned to you, that you need to have a corporate structure. Now that you are going to, gel with the other competition outside, family businesses earlier used to have estates, trust, even right now they may be having, but also a corporate structure is now evolving. They are more into private limited companies, they are getting listed, or they are wanting to, they are already into family partnerships and they want to get into corporates. So what is important is also to have a shareholders agreement. Even though it's in your family right now, you need to have a shareholders agreement very clearly listing down what it is. If you have a family will, that would also be very useful. And always, if the will is going to be having future succession plans also mentioned, it is very, very important to have those documents. Formal structure for discussion and decision making should be there. What the families should have is they should have a formal structure for discussion and decision making. And also they should have entry and exit level clarity should be there with them. Whether, what will be their entry options, what are their exit options, what is their succession plan. So succession many times is a very emotional discussion and the family members are avoiding to discuss. But I have observed that professional help is really helping them to resolve these issues and are able to help them, get their goals and the company's goals in a tangent. So many times succession plan issues are also killing the companies and they are not able to come to a consensus level. So I think taking professional help there would be very useful. And you need to professionalize your business and encourage the family members' contribution and their suggestions, but ensure that the business and the family members conversion their ideas in such a way that there is a continuity in the business, and as well as the common objective of the families are also met. So how is technology and digital transformation we need to do faster? Many entrepreneurs have still confirmed that they are very slow in the digital transformation process. It is not up to the mark in which how they should be right now. So what is pulling them back? What is happening to them in terms of digital transformation? Huge efforts have been made by all the entrepreneurs. I can see all the businesses that in developing, putting digital transformation on their priority, but it is a much talked about matter rather than doing it. So the youngster generation is stepping up to drive digital transformation in their organization. and making a large impact for good. Yet still can be done more to ensure that their voices are heard and acted upon in defining the family business, direction for the future, and shaping the legacy. So you see technology enhancements as a whole, because what I'm seeing is that many times, we are so much investment is getting made in technology, but as a whole, we are not able to see. One time we are making an MIS system, one time we are making we are doing something in the accounting system, one time we are doing customer facing system. So what I would suggest is that now technology has, evolved so fast. We have full stack systems that you need to see an end-to-end solution. You need to put all your technology plans of whatever are your technology contributors, whether it is facing to the customers, it is facing to your suppliers, it is facing to, your accounting side of it. Whatever technology, it is an enabler to your business. It is your own website. Whatever enablers are there of your business, the technology side, all need to be put out in a proper chart. And there needs to be a proper technology agenda of a technology path for the company. And based on that formal documentation for technology enhancements, a formal discussion needs to be held. And, you need to understand how your data and your assets, now your data assets will be monetized. So complete, commitment of your buy-in of your workers also need to be there together, because ultimately technology is also going to be operated by them, right? So many times when you're doing your accounting packages, the people who are going to operate also need the skill set. So you have to have equal focus to upgrade them, skill them, because I'm seeing a huge challenge in companies who are, more than 100 years old. 3 companies I have done entire system implementation again of already what they had done. And what was one of the main reasons given for their earlier failure was that their people who were there with them since generations were not able to adopt to the system, though they had hired many new people. But it is all about your leadership also. So if you feel that your family members do not have the adequate leadership skill for technology, taking the technology agenda ahead, then you need to have a leader who understands technology, understands and then implements them and gives required skill set to all your people also. You need to provide proper skill sets. Transformation has to be as a cultural shift. Because if you are still going to every day see MISs, written down on a paper or maybe by an email or maybe a report which is on a standalone basis. So if you are going to have too many MIS continuation in your company, then technology itself is not going to be, you are going to continue your business in the traditional way in which you're continuing. But you are just, trying to enhance one more channel by putting a technology. So that would not work. It needs to be cultural. Cultural shift has to come in all the people. And that cultural shift can only come from the owners, promoters, because the way they see their business, the way they feel, important about technology, the way they describe and they put their important time would reflect a lot on the people below and give them a very clear sense of direction and understand that it is a change now or never. Because you can start the process of technology by asking right questions, or how can I make this better? How can I optimize my data assets? Do I understand the critical success taken for this transformation? Is my workforce ready for the future? Are there skill sets developed? And the next generation, fortunately, are so much into this ERP system, so they are able to take this to a good level. But however, an external help sometimes also would be more useful to understand the overall, because you are investing so huge. And there are many family businesses who have already invested a lot in technology. And they are now struggling because certain technology, of course, with time, technology has also changed so rapidly that certain technology has, got obsolete. And it is very difficult now in a situation where they have to now take a call of how to go next on technology transformation with those assets on the books. So I feel that technology is an extremely critical enabler for your business, for your growth, for your success, for your scalability, and please give it importance, the due importance that it requires. And it requires a very separate agenda, a very separate leadership team within maybe your family members, outside family members, and it needs a thorough analysis of what are the enablers, like who is going to implement them, are those people trained, it's a cultural shift that one needs to bring in, and the technology needs to be updated in a very, very apt manner, which is looking at the future also of the company. Please avoid stopgaps, because if you put technology investments as a stopgap, that right now let's do this and then later on we will see that, then so see, this is where if you want to upgrade to a very good technology and you know that your businesses require this technology investments, then what is very, very critical would be is that you need to then have funds and resources available to you. And because you want these funds and resources available to you at a cheaper cost or at a competitive cost like your competitors in the business, so that your business is affordable, it is very important to have governance and communication, constant communication, so that your businesses reflect values. What you are seeing in business is reflected to the outsiders and the investors. The investors could be anybody. It could be even the banks who are lending money, or it could be NBFCs. It could be investors in equity who would wanting to put money in your business. So governance is very important, and technology is a very important part where investments are hugely required, because the way businesses have got disrupted, if it is not now, then it will be never. So as a whole, technology enhancement have to be used. Prioritize having a roadmap. It's better late than never. So what is the next generation family businesses, business model and finance model? Now, why this is so critical? Business model and finance model is there in all businesses. But why is it so critical in the family businesses in the next generation is that now the possibilities of, you want the next generation to understand what are the business model as of now with this disruption finance model and with this new technology and the possibilities and how the demographics of consumers are changing, how you plan to grow. What are the new streams of businesses that can be possible from your stream? How your businesses still can be scalable? What could be the new stream of revenues that could come in your business? So because for all these discussion of a business model, revisiting it would be extremely important, and you need to have a document which is covering very minutely all your assumptions, your business model as of now, how you are operating, your finance model and possibilities of your plan to grow. And also you need to have accurate numbers. Friends, this is something now in entrepreneurship, I'm sure you all guys also would have experienced. So entrepreneurs have certain things, perceptions in their mind of how the business is working. So accurate numbers in your business performance are very, very important. You please ensure that, you are communicating your team members. I mean, what you are having perception of your numbers and your performance is matching with what the actual books are saying. Okay. Do not stay in any perception, because the way businesses are getting disrupted and the inflation of cost and the way competition is merging up, if you lose on your number game, it's going to be extremely difficult for you all to survive. So I think the next scalable, even though how much ever, because the advantages with businesses are they are more resilient, they have a more long-term view than the normal businesses, who are not from family background. So all the businesses who are, from generations, they have a very long-term view of the industry, which is a very, very positive sign. They have a high resilience, and because of this, they have a very good success factor. But however, on the numbers, it is now no longer a perception game. It is needs to be very, very accurate. Your business performance has to come in the books the way you perceive. So that's very important. Spend some more time on that. And, because this has been very, very practical experience of companies who are even more than 1,000, 2,000 crore. And, the promoters and, so there are books also getting audited and published, but, based on their performance of what are their gross margins, what are their net margins, they have certain perceptions. So do not go on perceptions. Get the ratios right, get the percentages right, get your ROI right. Also, do the team members understanding on the business performance similar to your understanding on the numbers? And is the MIS in place with key metrics on timely basis? So this is also one very important thing I have seen in decision making. Decision making in the family businesses somehow are struggling and not so much able to take timely decisions. So that decision making needs to be very correct. And this will only come when you do family governance of putting in place what are the rules of decision making, timely decision making, and of course in the organization also structure. So you put these policies and processes in place. One of the things that can help you is put a matrix and chart very, very clearly, saying list down the key objective areas, your key strategies, your strategic area in a discussion. Who will be the approver? Who will be the proposer? Who will be the decision maker? So who will be the supporter? So once you have these things mentioned, each one knows their role very well in the organization, whether it's a board of directors, whether it's a board members, whether it's the CEO, whether it's a promoter, whether it's the family member who is actually spearheading that particular function. So put up a matrix, maybe in a very simple form. This may look like a very simple document, but it will require a lot of brainstorming, and it will require that how decisions are not delayed, but are taken very quickly. And you have a start date and end date of every agenda whenever you are doing any critical like technology. Then you have a discussion on technology, and you ensure that your agenda is very, very closely monitored, and you have key dates of deliverables. So that way I feel that communication within the business and within the team members would flow very well. Friends, also one of the very important thing is talent, getting good talent. So family businesses are always complaining that they are not able to attract that good talent. What the resources, senior resources would like to go. Good talents would like to go in a corporate business rather than in family businesses. So what is the reason for this? This is the reason, friends. We need to have a family structure. We need to have the business operated in a, you will see many, many industrialists now declaring that their business is a corporate business. Their children will also have to come through the same training if they want to go up the hierarchy. Why is that so? Because they are understanding the need of, coming in parallel with the corporates and saying that, our business is independent of our family ties. So each one has to establish its own importance and values, and they have to run up the ladder. So that is the reason why, it is very important to attract senior talent, to attract good talent in your business. It is very important to formalize, professionalize your business in a manner in which, it is running like a corporate business. So there is an enabler, there is a provider, there is a supporter. So mention all those things extremely clearly. And, let there be a brainstorming on that along with your key team members who are not from your family as well. And once everybody's consensus are done, put that document in place. Believe me, it will work miracles, because then the senior people also know the clarity of, where they want to head, because their speed is, your business speed is going to be their career speed also. So remember, nobody is going to wait for us to spend years and years in your family business when you are very slow in growing. So they need that kind of pace and platform to put their action in place. And if you do not give them that platform, independent platform, then it's going to disrupt your business only. So you need to be very sure about where your business is growing. So give them adequate importance, because you have hired them, you have paid them. So you need to take benefit of all their knowledge and, put up a matrix in place where proposer, decision maker, supporter, everybody is mentioned and everybody knows their roles and responsibilities, and the timeline is adhered to very clearly. There is a timeline for everything. So we are coming to a very, very important part now of conflict management, because 90% of the Indian businesses are family owned and only 30% are successful. This is what the research reports show. So do Indian families talk openly about, their succession plan? Do they openly talk about, certain leadership consensus? Are they, if you are talking about succession, some people in the family, senior people may have this, they may feel generation gap, they may feel disrespected. But we have seen over the time, and more so now in COVID times, that how much important it is succession planning, and how continuity of business is very important. So the outside world is going to look at your business being successful as one of the parameters of, do you have a continuity plan? Are your business going to be only with, say, Ratan Tata being there and then Ratan Tata not being there? Is the business going to come to a stop? So what are your things that I'm just suggesting is example, but I'm just saying that in your business also, though you know that, your all family members know everything about the business, it is very, very important to formally document this. It will go a long way, even in people who are, say, suppose if a succession plan is properly drawn, then the successors also have the time to, get themselves trained in that manner, upgrade themselves and ensure that they are ready for the taking up the challenge. So, succession plan is fine. And also, one of the very important thing is the second generation is seeking increased authority and responsibility. And interference from the promoters, and promoters in the sense the person who is running the company since years, generation gap. But based on my experience, what I believe is that we need people with experience, because they have experience of so many years running the business, as well as we need the new talent of next generation to understand what is the environment in which we are now. As I mentioned to you, it is a complete digital technology kind of an environment where consumer behavior is going to significantly change and is actually changing. Demographic is completely changing. Your consumers are no longer going to be of your generation, they are going to be of the next generation. So how the businesses are evolving, how environment is evolving. So it's very, very important to have a balance between the new generation ideas and their investments, and the promoters wanting to control the business. So this can only be possible, friends, only with a proper structure of decision making. Have a proper structure of decision making where there is a proper discussion, formalized discussion of issues, not only on your lunch table or dinner table or anywhere, but on a proper forum. And it is always advisable to have leaders, expertise in your own organization also, who are there to participate in that discussion and have an objective discussion rather than an emotional discussion. Because one of the things where I feel that the senior guys are getting swayed away is, of course, their emotion towards business. So they feel that, all this is getting disrupted, and this is the way we were doing business and everything. But that's not true. The young generation today is able to take up the challenge of taking it up to the next level. So I think that they should be fairly given a chance and platform to express their ideas and brainstorm, and take outsiders, take professional help, professional talent in your organization also. Their leadership, involve them in the discussion. It should not be only to your own family members. Involve them also in the discussion. Arrive at a proper logical business sense according to the industry. Get an industry expert also along with you all. That may also help a lot to give insights. Do a brainstorming and then arrive at your consensus of where you all want to go in future. So I think that by doing a very formalized, objective way of discussion will then not frustrate the young generation, and the conflicts will also not be, you'll be able to address them very, very correctly. So do not ignore any conflicts, friends. So what are the root causes and effects of conflict? As I was just mentioning, the organization culture, the structural plans may not be, agreed by the next generation, or they may have some suggestions. They may not be clearly understood also by many. And it may be, comparing who is maybe some kind of ego issues, of course, are always going to come, or lack of professionalism. But once you put up your family values and business values in place, and once you communicate to everybody that this is how we are going to operate, and the company is going to be non-subjective to, any family member, and then this is the way business is going to be given a priority, I think that they will then fall in place. And even the new generation, they require a lot of clarity in everything. They want things very simple. They want clarity in everything. They want a go-ahead, go-to-market strategy, you can say. That what is it that we have to do to now get our business to success? So if all those are not, served to them at a correct time in a correct platform, so, your traditional businesses, you will have very senior people in your traditional businesses, but also take opinions of leadership teams in the young generation and ensure that you have a right mix and balance of both. And then you kind of take a decision with a proper discussion, formal discussion, and make it, it needs to be, of course, very logically arrived at. So what are the effects that have, the conflicts can have a very bad effect. It can erode your economic value. It can lead to separation. It could lead fractured relationship between the kith and kins. So we have several examples where, as I mentioned, businesses have gone in a thing because of all these issues, and serious business erosion has happened. Economic erosion has happened because of their conflicts. So family conflicts usually start with many a time maintaining overall control and influence over the firm. It pushes the family to take decisions independently, and financial consideration or non-financial consideration. The freewheeling entrepreneurial startup culture, which took the company to great heights, abruptly changes to territorial mindsets. So what happens is then, you are into political interpersonal fiction, bureaucracy, staff functions are affected. Your family becomes powerful, but at the expense of the line functions, and organization loses its ability to respond to fast changing environment. And this is, friends, really happening, that, your ego issues, or you want to keep control of your business. But, what are you losing? You are losing the, your fast changing environment. You're not able to cope. You're not there only because your line functions are totally affected by this. So, once the shafts sees a split, then either way they will either go to, one side of the place or the other side. So the families in the business need to nurture their members' feeling of trust and pride concerning the family and business, as well as build a sense of teamwork to keep a family committed and disciplined in its relationship to the business. It is wise, therefore, in the family council or family assembly to emphasize consensus decision around family goals and policies. So family council is important when you are more than 15 members in a family who are owning this, maybe 15, more than 15. So what happens is then you have an equal representation from your each family and form a family council who will then take decisions of your business on behalf of the other owners. Or, you can have a goals and policies, openness to various viewpoints, significant transparency in company operations, decision-making, ownership holdings. If the family is reluctant to engage in the discussions, it needs to be, it needs to be having a family council who are people then whose actions would be then agreed by all. So decision-making is very key. And you can hire a facilitator also to help you organize the meetings. Good structures that do not address the right topics are a complete waste, costly waste of time. So lots of meetings happen, but then they are all waste of time if they are not organized in a good structural way. And if the points are not noted down in an agenda is not there, if the minutes are not taken, if they are not followed up, if the action is not taken, if the review is not there next time of what those decisions were. So all those discussions will be a huge waste of time. So one needs to be very, very careful of, how you are going to have a good structure to address the right topics at the right time. And I want to point out again that a family council or a family assembly components do not replace the board members. You have this family council is just to take the approval of the key stakeholders and owners so that the decision making is not delayed. But that does not mean that the board structure is replaced. The board structure may be of independent directors, maybe of other directors, maybe some other stakeholders. But if it is predominantly owned by the family, then the family consensus is also very important. So that is why you need to have policies, recommendations based on that. So they should coordinate with the other board members. They should sit in the, the important objectives and points that are discussed in the family council or the family meetings or your internal family should also be communicated with the board of directors or maybe a formal leadership team in a very, very, transparent way. So that everybody is informed and they both are, gelling well. And that is giving a sense of a corporate organization. So family constitution articulates a family's vision in itself and the business, its core values and policies and guidelines that maintain a family discipline. So that is a family constitution, right? It articulates a family's vision and then policy and guidelines that maintain this discipline. Among the family policy, they might create that what are the employment standards for the next generation? What are your career development policies for the family members, for family employees? There may be employees also, or your family members who are employed in your business, but they are not owners. So what would be the career development? That also you can put in place in your family agenda. So what are the succession process? What are the retirement ages? What should be the ownership, including buy-sell agreements? So all these need to be very structurally put up. So conflict management is, creating a codifying your views. Whatever I said, once we codify it into a proper structure, so that becomes your policy, your core values and your growth plans. So either you agree or you don't agree. That's it. And then you just move on. You either agree or disagree, and then you move on after taking a decision. We cannot keep lingering on that topic of conflict, So succession plans are there. Then facility, somebody who is going to be a facilitator. A family charter can also help a lot. You list down all the things that are, are core to your family. So effective tools of effective conflict management is going to be having a proper structure of decision making, in place. I think that's very, very critical. So what are the 6 T's that are critical? What people talk about is technology. We spoke about it quite in detail. Time management, as I told you, very, very essential. The target measurement and periodic review. Whether you're measuring all your performance, whether it's financial, non-financial, are you measuring them and reviewing them from time to time? The trust factor. As I told you, they could compete with outsiders, with your competitors, outside market, only if you build the trust. Trust is important. Transparency. And, you are having the correct team. So the team could be, outsiders, insiders, your family members, team could be, but, you please put down their KPIs in place. What is expected out of them very, very clearly. And whom they are reporting to, their reporting structure also needs to be, mainly all the key critical action points, who are responsible, who are the enablers, that also very clearly. So the team is highly motivated and having clear action points. So these are the 6 T's that one need to be very confident. Are the decisions made on timely basis? And is technology adoption just in action or only spoken about? So I feel that to sum it up, this 6 T's would help entrepreneur, family business run enterprises to move to the next level, where they are aspiring to get publicly listed or getting private equity funds, or competing with the corporate world by scaling up their businesses in this new age environment in a much faster way, with their new generation actively participating in their business. So
thanks, Falguni. There's excellent, and I know there's a lot more we can cover in the future series. Vikas Jaiswal, you wanted to say something? Vikas, you are still there?
So friends, with this, I finish my presentation, and thank you so much for being a lovely audience.
Vikas, Mr. Jaiswal? Till Vikas comes, Sanjay.
Can you hear me? Vishal?
Yeah, Vikas, put on your video and please also
Okay. Okay.
mention your
Okay,
name.
I'll do that. I'll
mention
do
your
that.
name and qualifications
Yeah, sure.
and what you are doing. Yeah.
Sure. This.
Put on your
I
video
don't know.
first.
Yeah. I'm just trying to. Okay. Zoom is using front camera. Okay. Am I visible now? Can you see me now?
Yeah, we can see you, Vishal.
Yes,
Okay.
yes.
Okay.
Vishal, now we can't hear you. Yeah, now we can hear you.
Okay. Is it better now?
Yeah, it's better now, Vishal.
Okay. Falguni, thank you so much. And thank you so much to all of you who are present Saturday morning and for organizing such a beautiful session. My name is Vishal Jaswal and I have a similar kind of experience as Falguni has. 25 years in the global financial and derivatives market, leverage products market to be precise. Not only derivatives, but also any kind of leverage products market. I've set up companies in overseas SBUs and was part of setting up companies and probably was the one of the key spoke in terms of when the India was evolving in as a derivatives market. So that's, and I have an MBA and international trade management degree. For last 2016, I came back to India. I was overseas and decided to start my own. And today I have a financial services company where we do the third-party distribution, third-party financial product distribution. Basically investment advisory and stuff like that. So that's my introduction. And I thank you so much, Falguni, because you have very well described and presented the entire family business structure and what should be done, what shouldn't be done. Can I add something if I have 2 minutes?
Yeah, sure.
Okay. See, some of the things which are uncompromisable in any business form, which is compliance, governance, and all. So that's holy grail for me. I mean, but two things which you have elaborated. I would concentrate and would say that it's very important for any business to flourish and take it from one level to another level is conflict management, as you said. And conflict management is not only part of the family business, it is part of the global corporate world as well. And I've seen, I've worked for foreign banks, I've worked for other entities overseas. The politics overseas are much more dirtier in the corporate world than the India you can think of. So conflict management, whether it is a small level in the family business or the big corporate level, or the difference of opinion between SBUs, management, board, the one side of idea will not, probably is not well taken by the other side. These are part and parcel of the daily life. So conflict management is very important, and that's where the leadership comes into play. So leadership is so very important. Don't leave conflict management for tomorrow. Address the issues today. And as you rightly said, that people have to be big-hearted, saying that not all his ideas and have to be incorporated. Ideas should come, and but once the decision is taken, move on. I mean, and probably that you can, if you are so very convinced about the idea, then represent it when the time is conducive, when the right kind of management is there, when you see that these ideas are workable, even at that point of time. So the conflict management is very, very important. And second is the risk management. Risk is, I'm not talking about systematic, unsystematic, known risk, operational risk, which comes into daily life. but the risk of future changes. Falguni mentioned demographic changes, technological changes, the kind of talent you want to hire over a period of time. But family business ke saath, one of the major problem is when you start measuring everything on a scale. Life is not about taraju कि ये दोनों साइड बराबर होना चाहिए. People should have the magnanimity to know that life doesn't work that way. कभी एक साइड भारी होगा तो दूसरा साइड हल्का होगा. This is part and parcel of life. Give and take होना चाहिए. Risk management में I can give you an example, that two examples. One business has moved on and has become very big business today in the financial world, and this is India's story. Started with a family business, and today they have grown to a very professional business house in India. But the same kind of organization which scaled it itself to a certain level, but today they are not able to move. Today they are having an existential problem because of the approach. An approach doesn't change in one day, because it's the family approach or the individual leader's approach in a family business comes over last 50 years of his life. The way he has grown up, the way he has seen his family reacting to and taking decisions on various issues, and it gets passed on to the next generation. I know this father-son, where the father was hardly educated, but he scaled up business to a certain level. But son also probably developed the similar mindset despite having a CFA and management degree from a big, from one of the best institution in India, because the approach did not change. So approach is very, very important, and its leadership has a huge responsibility to be open. I was hearing the two ideas.
Vishal, really sorry to interrupt in between.
No. Go ahead, Falguni.
Thank you so much for appreciating my presentation, and that means a lot to me. But may I request the people who are participated, and I can see a huge number of people known to me in the circle also who are there on the there. I would like to finish the question and answers, because I have to move on to another meeting.
Sure.
So I won't be able to be on this forum. So I would open it up to all the participants that if they have any question and answers. Questions for us as a panel.
Anil, you are there. Anil, you wanted to say something? Anil?
Participants, whoever want to ask any questions, please feel free.
Anil, are you there? Acha, Sanjay, I would request you to share a few thoughts with any experiences on this after the presentation. She has done a wonderful presentation. Sanjay?
Yeah.
You are there?
I think this is
share a few thoughts and any examples and your experiences in brief.
Sure. So I think Falguni has given us the great insight. Just to add a couple of things here. See, we have in family businesses the development of power centers. As the ownership grows, the business scales up, the challenges of managing the complexities, business models. So that power center, how it can actually be replaced by a sense of ownership, sense of what we call the real effective growth performance metrics, that is the key. So you need to manage the emotions and economics. Let me give you two E's around businesses. I mean, obviously there is the emotions attached to your ownership, and therefore now you need to start channelizing that emotions into economics. I mean, that's a journey which we call a true transformation for any business to figure it out, the key management depth as you evolve into a real institutionalizing your business. So there is a journey from family to institutionalize, and therefore in a true sense you are developing a real corporate business structure. So that's very critical. So you need to share your values, share your value, share your wealth creation, through the stock options mechanism, through a right incentive metrics, and therefore there you are heading a right business metric. And I have seen, in fact, just a few, about 2 months back, I got call from one of the 400 crore business owner, and he's saying, यार वो L&T का L&T ने कुछ इंफ्रास्ट्रक्चर का कॉन्ट्रैक्ट एक स्टार्टअप को दे दिया है, जबकि मैं 600 करोड़ का धंधा कर रहा हूँ और मेरे को बिजनेस नहीं मिल रहा है. मैंने बोला बॉस आपको बिजनेस नहीं मिल रहा है, उसके पीछे बहुत सारे रीजन हो सकते हैं. One of the reason is that probably you don't have those kind of what we call the insight about getting into a new business model from the digital or from a technology point of view, or the real the what we call the technical input which is needed to develop such a thing. So you need to create some of those business models, and therefore you need to ask yourself, am I in the right business model as the new startups come and they grab your business? So that's where he got an insight about, and I told him, are you developing a corporate governance? Are you developing the insight about new startups? Even you are participating as an angel investor to catch such, good, what we call the new business entrepreneur who are developing such models. Okay, forget it. If you don't have an internal management skill, why don't you tape such startups and be a part of angel investing and get your scale up from that perspective? So then he got the real insight that what he should do in terms of leveraging the network, and by figuring out the angel network and getting into those kind of things. There was another guy called, which is running a 300 crore textile business, and I was surprised that he doesn't have a CFO. So, and he himself is saying, this is my valuation, this is my potential, share which I can give it to my investor, and I don't need an investment banker, I don't need a CFO. So I told boss, how you yourself can assess the business? I mean, let there be somebody else who actually participate with you and take your business to the next round of, business value and business this thing.
Yeah,
So,
Falguni,
I mean,
please remove your screen so we can see Sanjay on the full screen. Just remove the presentation mode. Yeah, so we can see Sanjay and others on the full screen. Yeah, Sanjay, please carry on. Falguni, just remove the screen sharing.
Yeah.
Then we can have Sanjay and others on the full screen. Yeah.
So these are some of the, what we call the resistance to change.
Falguni, can you remove the screen, please?
I think Falguni is not able to hear you.
No, she is there because then we can see all of everybody can see all of you on the full screen.
Yeah. In the meantime, Sanjay ji, you are
in the
so
meantime,
very
Sanjay,
correct.
continue. And after Sanjay, Anil, you have a lot of experience for last 40 years with business groups, and anybody can raise his hands. And then the Sanjay has agreed to, and Falguni will address all the issues. Anybody can raise their hands. Yeah, Sanjay, continue. Yeah.
So I will just conclude this session with the 6 T's which Falguni has explained. We need to be, family businesses need to manage these 6 time bombs. Let me put it this way. While she has managed to say something about 6 T's, I will add one more T, that you are actually carrying a time bomb if you are not exactly able to shape up these 6 T's in a right way in terms of scaling up, institutionalizing your business, corporatizing your business. Therefore, it is very important that emotions and economics of the business are being taken care by a sense of good management team, a sense of good functional experts as you grow your business. And therefore, the last thing which I want to add here is that start sharing your wealth, start sharing your incremental wealth, incremental value, which you are creating with your tier 2 management team. And therefore, you are creating a real long time succession planning and the management structures. And that addresses the sustainable value creation.
Thanks, Sanjay. Anil? Anil? I think Anil is having, yeah, you are there, Anil? Anil, we can see you. Anil? We can see you on video. Anil, please speak. Unmute yourself.
Yeah, I want. Yes. Can you? Hello.
Yes, we can hear you, Anil.
And you can see me as well?
Yes, yes, very well.
Yeah, this was an excellent presentation, and it is actually need of the hour also, you can say, because in last 40 years, I have been very close to Manoj, and he knows that I have been exposed to SME and sector. And I have seen a lot of family enterprises flourishing in last 40 years and then vanishing after when the new generation walks in, or there is a change in the way the businesses are being conducted and they could not cope up with it. So India, now that India is a growth story, a very big growth story, as we can hear it from all the sectors, right from overseas and India as well. And the experts on the, so here comes the role of a CFO is very important, because how the whole transition and to, basically as has been discussed at various point of time in this whole presentation, that India is a country where the family businesses have been the way, even you can call Reliance Industries is also a family business, just to quote one. And the importance, the differences which arise between the various participants of the group, family business group, how to tackle that and how to keep the business survive. These are the challenges, and this type of discussions definitely help us. And businesses largely fail, according to me, is not keeping pace with the changes happening in the environment, business environment all around, including the compliance part and the way business, like we are becoming more digital now. And I have now seen that some companies which are predominantly exporters have now become local suppliers. Domestic market has been opened up for them in a very big way, because people are now buying more and more products for self-use in India. The lifestyle pattern and the whole thing has changed, So this is some small input I can discuss about. Rest is Falguni has done an excellent presentation, and that covers basically everything. Thank you.
Thank you.
Anil.
Thank you, Anil ji.
Everybody is welcome to put any questions. There are lots of very good comments which have come up in the comment section. Put up all the questions. Sanjay would answer everything. Falguni would answer. Anil, Umesh would respond to all the issues. We have a fantastic presentation coming in where family and family businesses are investing alternate avenues, first class, very high quality presentations. Be ready for that, and please post your. All of you are welcome. As Hemant said, Think Tank Conclaves is on LinkedIn and Facebook. All of you can connect together on Think Tank Conclaves with LinkedIn, as Hemant announced in the beginning itself. Sunil? Sunil, you are there?
Yeah. Yes, Manoj.
Some thoughts about you on family business, and be ready to share the presentation while the questions come. Yeah.
Yeah, I'm ready. Let me know whenever you want me to start.
Yeah, Sunil, some thoughts from you on family business.
No, I think enough has been said. Very good wisdom. I mean, a lot of wisdom around management lessons. All are very valid points. I think what I have generally, just one small observation is that the structure is not in place, which is true, and therefore the hierarchy is not in place, and therefore when you try to invite professionals, they feel that challenge, because the professionals inducted in a family business, they expect professionalism, they expect hierarchy, they expect the clarity about their own role. So that is what often is challenging, and which is why the talent doesn't retain in family business. Nothing much from my side otherwise.
And Vishal, I would say you are welcome to participate regularly and speak, and also one day soon make a presentation on the India growth story on a professional topic.
Yeah,
sure.
Sure. I have a question in general with everyone. Anybody can chip in. Falguni, Sanjay ji, Anilji, they all have so much of rich experience of India and the way their business happens in India. See, 2016 when I decided to come back to India, return to India after
You
leaving
came
my
from where, which country, and what you were doing there?
Okay, I had set up a spot currency business company from scratch in London. We had a London regulatory approval, and then we set up the operational team in Mauritius because that was economical to operate from. And but the major head office and registered office was based out of London, so I had set up the company from scratch. So after that, there were some few issues with the management, which had initially committed to complete free hand because it was my baby and the way I wanted to run. In terms of the way the compliance is, and I was little strict on the compliance side and all, which was not very, with the promoter. So I decided to come back and start. I thought maybe I have given enough to the corporate world, and let's have something of my own. That's where I had a couple of investors from Europe who was ready to put in the money in India. And that's where I came back, set up the company. And when the fund
So what's
was
your
to
question
come,
briefly? Just a short question. It will be
Yeah.
answered.
Yeah. Okay.
Yeah.
The question was this, that when I decided to come back, we had a couple of investors who had committed to funds in India. But immediately after after that, the demonetization had happened, and they were slightly disturbed with the way the things had panned out, and they backed out. And ever since then, I have got stuck up. So is there, if somebody can suggest that how we can raise funds in India, despite being a small company, it's purely would be on the complete forward-looking thing. We do not have a very big background to show and the revenue structure at current point of time, but it has to be purely believing on the way, on my experience and the way I want to take the company forward in terms of.
Got it. Excellent question. A very important question. And I would just mention, I will request Sanjay to respond also. And Falguni would also do. We had a series of roundtable discussions with presentation on fundraising. We have done fundraising from banks, institutions, fundraising from startups. In fact, in this series itself, like, Vikas Agarwal, he's a very well-known, renowned person on fintech and regularly involved in fundraising. Falguni herself made a presentation, deep dive discussions, which is on YouTube as of now for a limited period recently, how to do fundraising for startups and what steps to do. Go through that and please come again. And it's a part of a series, how to do fundraising with equities. And she is planning to do another session on fundraising through debt markets. So all these caveats are taken care of to safeguard the interest of all startups, whether they want to do at the first stage or second stage and last stage. So that's a lots to come. And yes, Sanjay, can you also supplement this?
Yeah, so Vishal, I think in terms of fundraising, it's very difficult to give you a straightforward answer to why that you are unable to raise and those kind of things. But let me tell you, the India represents an enormous opportunity. You need to have a right business model and the right team in place. That's a way to get the interest from the investors in India. There are a whole range of family offices, VCs, angel investor network. Then there is even the debt market potential to leverage on the equity. So I'm not saying here that what is that could be the reason that you are unable to chase. But there's only one thing which I can add here is that if you have a right mix of business model and if you have a right mix of execution team on the table, I think the India represents a right market and the right way to create a value.
Thanks.
Okay.
Sunil, let's start your presentation. There's lots more, and Sunil will also We'll respond to every issue on investments. And Vishal, please be there for the future series. There's lots more to be covered.
Okay.
Yeah, Falguni, your last word to Vishal.
Yeah. So Vishal, what as Ms. Sanjay ji said, I would also suggest that, early traction I covered last time in my last series, that when your business is not having a traction, which is required for investors to invest, because they need certain kind of traction already. If it is only an idea, then ideally, it will be either your family members or close members or angel investors. So there are angel investors who only based on the idea and based on your experience can invest in your funds. So, you'll have to reach out to those right kind of segment people. And then once your traction is reached with that investment to a level, then you can kind of get into VC funding.
Yep. Falguni, it's not that I'm alien to the investment,
Sunil,
startup investments.
It's okay. Sunil can start his presentation. You be there and we'll answer all your questions on investment.
No issues, Manoj. I mean, I just wanted to say that can we share each other's contact so that we can connect on
actually everybody can connect.
I have put it in chat, my contact.
Conclave on LinkedIn. Actually, everybody can share their profile.
Okay, I'll also share my.
Think Tank Conclaves is on LinkedIn and Facebook. All of you can share your profile so one can connect. And there are many fund managers and top corporate and professionals there on that. So need not connect with one person, just connect with everybody.
Yeah, I'm with my name. I am also putting my contact
That's
number.
okay. That doesn't matter. We have thousands of speakers together coming
No
regularly.
problem.
Yeah.
No problem.
This is an interactive session, especially on request of participants. But there are lots of sessions over 200 roundtable discussions have been held in pandemic, which are shared. And this has been going on for last couple of decades.
So thank you everybody once again for joining me this Saturday morning and, spending your valuable time hearing me out. Thank you. I hope I've done justice to your time.
Yep.
More from you next time. Yeah.
Yeah, should I start?
Yes.
Is the presentation audible and I'm audible?
Yeah.
Okay, so good morning, everyone.
Let's have an interactive session. Anybody can post any question and everything will be taken up today or in the future.
So the topic is connected to stock market investments, and the idea is to familiarize all the investors who are currently investing either directly or through mutual funds or through any other vehicle with some of the nuances, some of the lesser known aspects of differences between investing through each of the routes. So one disclaimer in the beginning that the idea is not to tell you which mode of investment will give you better returns, but the whole presentation is mainly from the regulatory differences and understanding the product better. So whether you are an investor or a fund advisor or you plan to set up a fund in future, this should help. So I'm not able to change the slide. Yeah. Okay. So as we all know, the entire presentation is going to be about comparison between direct investing and investing through an advisor or a fund. So just to take you quickly through the fundamental differences between these alternate routes, though most of you who are investing would be familiar, but the basic difference in an AIF is that it's a fund structure, it's a SEBI-regulated fund, so therefore there is an expert advice and there's a common pool of funds, and therefore the units that you are issued have a value linked to the underlying investments. And this is mainly targeted at HNIs because of the minimum ticket size of one. In a mutual fund, again, it's similar because there's a fund, you don't invest, you don't hold or own the stock directly. Except that it's meant for retail investors because very small amounts can also be invested. Compared to that, PMS again is like investing through an expert advice, which is again regulated and registered with SEBI. But the stocks are held by the investor directly, almost like in direct investments. Is anybody on unmute? Because I can hear some disturbances. So requesting everyone to check and mute yourself, please. So with this fundamental difference between alternate routes, let me first begin with the comparison between some of these two. For example, let me begin with AIF and PMS first, and then we'll add the debt and the mutual fund angle. Because mutual fund is relatively simpler because people have been investing for many years, whereas the difference between AIF and PMS are not all clear. Most of them would be known to those who are investing, but there are some aspects which have a direct bearing and therefore important from the point of view of your decision making as to what's better for you, whether from tax efficiency point of view or cash flow perspective or liquidity perspective. First factor is investment decisions are obviously in case of AIF decided by the investment manager. In a PMS, you have choice of discretionary, non-discretionary, and advisory. In the first two, decisions are made by the portfolio manager with or without your investor consultation. Whereas in advisory, you simply get advice and you execute the decision, buy and sell decision on your own. Then next point is segregation of funds. In case of AIF, there is no segregation of funds required because there's just one single demat, one holding and so on. Whereas in case of PMS, the PMS manager is expected to open separate demat accounts and therefore the investments are visible directly in your account. And for the same reason, pooling of funds happen in case of AIF, but in case of PMS, it's separately identified with funds and pool of funds and the pool of portfolio of investments. In terms of restrictions, whether investments can be made in one investment company, that is the investee company, for AIF category 1 and 2, not more than 25% can be invested in one company, and Cat 3 is not more than 10%. Whereas in case of PMS, there is no such investment concentration norms. So therefore, if the fund manager decides, he can buy just a few stocks, which could be exceeding 25% of the amount which is invested by the investor. Tenure for closed-ended Cat 1 and 2, it's closed-ended generally because they invest in unlisted stocks. They cannot allow frequent redemptions and fresh investment because the valuation is not easily available and it's not available on a daily basis. Therefore, Cat 1 and 2 are closed-ended, and generally there's a minimum tenure of 3 years, and we've seen in practice that the funds have a lifetime of 7 to 9 years. In Cat 3, they can be open-ended or closed-ended. Generally, Cat 3 are open-ended because the valuation can be ascertained on a regular basis because all are listed stocks. Therefore, the NAV can be declared on a daily basis. Whereas in PMS, there is no fixed tenure, which means that the investor can invest and exit anytime. Lock-in in terms of for Cat 1, for closed-ended AIF, there is a lock-in period which is defined in the PPM, therefore it's contractually agreed. Whereas in case of PMS, one client can withdraw anytime subject to exit load. So the exit charge, as you can see on the next slide, is for AIF, it is contractually agreed. Whereas in PMS, you will normally see 3%, 2%, 1%, depending on when you exit. The minimum net worth of the investment manager, there is no requirement for AIF, whereas for PMS, it is minimum 5 crores. So therefore, as an investor, you need to know that yes, the PMS manager has enough funds, though it is supposed to be a fee-based income, yet SEBI regulation require them to invest, have net worth of at least 5 crores. Minimum investment by investor is 1 crore in case of AIF, and for PMS is 50 lakhs. Minimum corpus of the fund is 20 crores because you have to have 20 investors, and therefore each investor will have 1 crore. So accordingly, 20 crores. PMS, there is no limit as such, which means that the PMS manager can start with just one investor with minimum amount of 50 lakhs. Continuing in interest of investor, this is basically what is known in the industry as skin in the game, which means that the investment manager himself should have his own investment. So that is what gives comfort to the investors, that the same stocks are also being invested in indirectly by the fund manager. So in case of Cat 1 and 2, it is 5 crores or 2.5%, whichever is lower. In case of Cat 3, it is 5% or 10 crores, whichever is lower. In case of PMS, since there is a net worth requirement, there is no requirement for the fund manager himself to be investing in the same portfolio. And obviously, because of the structure, the funds and the stocks are held in the name of the investor, and therefore you can't be mixing the fund manager's funds with the investor's funds. Leverage, which means whether the fund can borrow to invest. For Cat 1 and 2 is not allowed. Cat 3, it is allowed up to 2x of the AUM, more than half. Leverage is not possible for PMS, again, because of the structure, because the investments are and the funds are directly held in the name of the investor. So with this, let's quickly look at the typical structure of an AIF, which for those of you who are familiar with the mutual fund structure, is very similar to in terms of looks, that you have a fund at the center, and which is shown in the structure at the center, and you have various service providers, in the sense that you have a trustee who sets up a trust. So therefore you need trusteeship services, and therefore there is a trusteeship services agreement to begin with, because they are the ones trustees are the one in a way who settle and therefore create a trust. And you have a sponsor who initially sponsors. So let's say HDFC Group wants to set up a mutual fund. So for all HDFC mutual funds, it is a HDFC Group or HDFC Bank or HDFC AMC, which is a sponsor, depending on who is the parent of the AMC. And then so sponsor's role is limited to the extent of being sponsored to initially to settle the trust and create a trust, and thereafter the trustee is appointed to oversee the trust, because trust is basically, for all practical purposes, nothing but a pool of money, a pool of funds. So it's like a bank account. It does not have employees as such. So therefore, every function is held or managed by the trustees. So it is the trustees who appoint various service providers, and therefore one of the service providers appointed is the investment manager, and then the investments are made. So this structure has to be kept in mind, because this is what defines as to how investor will be impacted or investor will be taxed on. So keeping this in mind, let me come to a few tax issues, and then we'll do a comparison of the tax aspects among for all the 4 routes of investments. So in case of Cat 1 and Cat 2, the fund is a pass-through, which means it is assumed that the fund does not exist at all, which means that the money comes in from the investor, it is invested, the fund earns the income, and it is assumed that the fund does not exist. Therefore, it is assumed that the investor has earned the money, has earned the income. So when the shares are bought by the fund, the moment you exit from the investment, you earn capital gain. Similarly, you may receive dividend or interest. It is assumed that the investors have earned that income, and therefore they are taxable on an annual basis immediately, irrespective of distribution of the fund. So therefore, the moment fund earns, investor gets taxed. Similarly, losses of AIF are passed to the investors, provided the unit's investment is held for 12 months. And because the income is all taxed in the hands of the investor, the AIF has to deduct 10% of tax in case of domestic investors, and for non-resident investors, there are respective treaty rates. And the 10% is applicable on all sources of income, whether it's capital gain, dividend, or interest. The TDS again is on accrual basis, because as I said, the income is taxed immediately. And therefore, this creates some of the issues which I will highlight, that fund pays tax or deducts tax and deposits with the government, irrespective of the fact that whether the income is actually being received by the investor or not. As compared to this, the Cat 3 fund pays tax at the fund level. So all the income gets taxed at the fund level, but the tax is nothing but the aggregate of the share of the respective investor. So the fund is expected to calculate respective investor's share of income, though the tax rate may be same on the listed stocks, let's say 10 or 15%. We will come to the rates in a moment, but the fund is expected to know what is the status of the investor, whether it is individual, corporate, partnership, or whether it is resident or non-resident, for FII and so on, and accordingly apply surcharge. And the surcharge is what makes a difference in the sense that surcharge varies based on the level of income and also based on the status. So therefore, the fund is expected to calculate respective share of income and aggregate and then pay the tax. And accordingly, therefore, investors simply are expected to disclose income in the return and say that the fund has already paid tax, and therefore for me it is exempt. So with this, let's look at quickly at the rates of taxes. So on top, as you can see, there are 4 columns: Cat 1 and 2 AIFs, Cat 3 and PMS and direct, and last is mutual fund. And then there are tax rates for different categories of asset classes. So you have long-term capital gain on equity, then long-term on debt, short-term on equity, short-term on debt, and F&O, and interest and dividend. As you can see that, as we all know, since we all invest in the stock markets, if you hold the stock for 1 year, then you pay tax of 10%. And if you hold the stock for less than 1 year, you pay tax at the rate of 15%. And that's the reason you see 10% rate across the rows, across all the columns in the first row, and 15% across all the columns in the third row. So therefore, that is as simple as that. That generally the fund will pay, we as investors will pay tax at the rate of 10% or 15%. And this is common across all the columns because that is how the law has evolved over a number of years, that now more or less things have equalized, except for Cat 1, which is the first column, because they also invest in unlisted securities. So for unlisted securities, there are higher rates, 20% on equity and long term, and 30% on the short term. What matters, and therefore what makes difference, is the rate of surcharge. And the surcharge is different, and therefore effective rate may slightly vary from, let's say, 11% to 12% or something. In some cases, there's a 0.5% difference in the effective aggregate rate of tax. So these base rates are increased by surcharge and the education cess. So surcharge is 10 or 15%, and cess is 4%. So that therefore the effective rate goes up, and therefore slightly different in each of these categories and investments. So now let me come to some of the challenges that investors face and even the fund managers face in case of AIFs and PMS. And therefore, after that, I'll take you through a comparative chart for all the 4 vehicles of investment, and that makes it easy for any investors to decide which is the better mode of investment. So first issue is there is a taxability of investors taxability in the hands of investors when there is no real income earned in the first few years, and this can happen in AIF as well as PMS. Because typically what happens is that the fund will collect the money from you, or the PMS manager will collect the money from you, and they may not immediately deploy the fund. So in the short term, they may invest in, let's say, liquid funds, and there may be a small income on that. So there could be small interest amount on that. But the fees that you pay starts right from day one. And therefore, there is from a tax point of view, the investors ends up paying taxes in the first few years, though there may be no real income, or there may be actually a loss because the expenses can be more. Second issue is that there's ambiguity around deduction of management fees as deduction in the hands of the investors. So typically, investors will end up paying tax in their hands as capital gains. But capital gains rules say that you calculate that capital gain in a particular manner. So you simply take the sale price minus cost minus the expenses which are deductible. For example, the brokerage you pay, the transaction charges that you pay on the stock exchange. But there is no clarity about the management fee. And generally, management fee is substantial. It could be half of the overall expenditure that you end up paying by investing through a fund. So the management fee which you pay, so in case of, let's say, mutual fund, total expenditure could be 2%. Half of that could be management fee, because there are certain other expenses also which are charged to the investor, and therefore they are borne by the investor. And therefore, there's no consistency as to what happens. There are investors who claim that separately in their own return. But if it is a fund, then so far as the fund is concerned, they will, if it's Cat 1 and 2, they will deduct tax on a gross basis. Similarly, Cat 3 will end up paying taxes on a gross basis. And the third issue, again, is related, is the securities transaction tax. This again is commonly mistaken that people often claim this as a deduction from capital gains. but capital gains rules don't allow a deduction for capital gains. And I've seen reports which are furnished by the fund houses or the brokerages. Sometimes they are net of STT, which means that the purchase price will include STT and the sale price will also deduct the STT, and therefore the capital gains are lower to that extent, which is wrong as per the law. The fourth issue is that the Cat 3 AIF investor cannot set off losses from AIF investment against any other gains or losses in the return of income. So this is basically an issue where the reason here is that the Cat 3 investor pays tax at the fund level. So therefore, he doesn't even get an opportunity to set off the losses. So it's only the fund which will carry forward the losses in the subsequent years and accordingly pay the taxes. And the fifth issue is that in case of Cat 3, the surcharge is often levied at the highest rate of 15% as compared to 10% on capital gains and dividend income. In case of dividend, it was till FY 1920 it was not taxable, but now it is taxable for the investors, and therefore the reason why fund levies tax at the highest rate is that there is no mechanism for them to ascertain the level of income or sort of establish the level of income or the status, and therefore they on a safer side they apply highest rate of tax. And therefore, that is a disadvantage for any investor to invest through a Cat 3 investor as compared to a mutual fund or direct investing. And the last issue is that in case of Cat 1 and 2, the investor can set off losses. So in case of, let's say, there is a death of the original investor and the legal heirs inherit the investments, it cannot be set off, losses cannot be set off against unless the legal heir also holds the investment for 12 months. So this is something which you don't find in the other mode of holding, for example, Cat 3 or mutual fund. So these issues I have now highlighted in the form of a comparison. So these next two slides basically compare the entire tax regime for all the four methods of investing: Cat 1 and 2, Cat 3, PMS, and mutual fund. And direct will be same as PMS, and therefore in a way it captures all the modes of investment. So as I mentioned earlier, the tax rate for capital gain is at the normal rate for all the three mode of fund except for Cat 3. And the reason, as I mentioned, is highest because of the surcharge that the Cat 3 fund levies. Similarly, the tax is paid by investor in all the cases except for Cat 3. Timing of taxation for investor is that, as I mentioned, that even if there is no distribution, the investor ends up paying taxes in case of Cat 1 and 2. And in case of Cat 3, when income is earned, again the same, even if there's no distribution, the tax gets paid at the fund level. So therefore, your NAV or the value of your investment gets reduced the moment you earn income, or rather the moment the income is earned in your name by the fund. Whereas in case of, again, the PMS also, the fact that you have no control, often in the discretionary investments, the portfolio manager is buying and selling the stocks on a regular basis, though they are not expected to churn regularly, but typically within their portfolio or the universe of the stock they select, they do exit often. And therefore, those capital gains get taxed in your hands, even though the money is still lying with the PMS fund manager. And all these issues which are there in the first three modes are in a way taken care in the mutual fund route, because in mutual fund, even if the shares are bought and sold by the fund, the investor is not getting anything, investor is not redeeming rather, and therefore it is nothing is taxed unless the units are redeemed. And therefore this big issue gets addressed through a mutual fund route. Similarly, in the next issue is taxation of income of investor even if NAV is negative. This is again, as I mentioned, that this happens in all the first three modes, because there may be no income or loss, and yet you end up paying tax in the first three modes. But there's no tax for the mutual in a mutual fund route, for the simple reason that if the NAV is negative, you don't there's no taxation triggered till redemption. So if there is a small income earned at the fund level, and whether the expenses exceed or not, whether NAV is positive or negative, just because the fund has earned income, the mutual fund investor does not pay any taxes. And in terms of last aspect is frequency of the tax compliance by investor. The investor has to file, show the income on a quarterly basis for the purpose of advance tax and pay the annual return. In case of Cat 3, you simply need to disclose, though you need to file a return and disclose, but show it as exempt. In case of PMS, it's like direct investing, and therefore you show the income and pay taxes as and when the tax income arises. And this again is easier for in a mutual fund investor because there's no compliance till you redeem. And the next set of aspects in the comparison is the first is the deduction of management fees, operating expenses, and exit load. So all these are not deductible for Cat 1 and 2. The Form 64C, which is issued by the fund to the investor, shows the amount on a gross basis. And therefore, investor can take a call whether he would like to deduct the expenses or not. And in my view, there is no reason why these expenses should not be deductible, because ultimately the investor is investing or incurring these expenses for the purpose of making investments. So directly or indirectly, the expenses are directly connected to the income that you are earning. And same goes for, in case of Cat, same goes for PMS as well. In case of Cat 3, investor can't even practically claim reduction because you're not even offering the income for tax. Again, this issue gets addressed in a mutual fund route because all the expenses get reflected in NAV, because the NAV is in a way adjusted of all these expenses. So therefore, only when you happen to redeem, the redemption proceeds are net of all the expenses, and therefore effectively you pay tax on the lower gains. Though the level of expenses may be very similar in all these categories, and similar level in terms of percentages and so on. And similarly, the STT, as I mentioned, is not deductible, and STT again is not deductible in the first 3 rules, and again gets effectively taken care of in a mutual fund rule because the NAV is adjusted of STT. And set-off of losses again is as I said, is possible for a legal error in case of Cat 1, provided the investment is held, by the investor himself, if the investment is held by 12 months, and is not possible in Cat 3, and it's possible in other 2 cases. And similarly for legal error is expected to hold investment for 12 months, unlike in direct stocks where the period of holding also is computed by taking into account the period of holding by the previous investor. So if the original investor or the deceased was holding the shares for 1 or 2 years, then the legal heir can immediately dispose of the share, and the tax will be on the basis that it's a long-term gain. So it is therefore possible for PMS and mutual fund investors to include the period of original holder, whereas it's not possible in case of Cat 1 and 2. And in case of Cat 3, it's not possible at all anyway, because the tax is not paid at the investor level. So with this, that comparison ends. I will quickly, this is my last slide, which I'll just take you through the compliance requirements. So Cat 1 and 2 fund are expected to issue a statement for all the investors in Form 64C. And the aggregate of all this data is also uploaded on the income tax portal in Form 64D. Therefore, the tax department has the information about all the investors, and nowadays everything is linked through PAN and other ID numbers. And the TDS payment which is made by the fund. The fund, whatever the nature of payment by the fund, whether the investors or service providers like the fund managers or the trustee services or the CAMs and CARVs of the world or the fund accounting service providers, there is a TDS requirement, and that TDS from investor point of view, that TDS is what you get credit for when you pay the final tax. And the funds file annual return, and that based on that, for audited, the audited statements are provided to the investor for their return filing. Similarly, for Cat 3, there is no requirement as such, or there is no prescribed form for the funds to provide any kind of certificate to the to investors, and same for PMS. But industry practice is to provide in a general statement. The AIF Cat will not provide the audited accounts of the whole fund, but the share of the investor, that this is your share, and you can accordingly disclose. And similarly, the PMS fund managers provide audited statements which show the capital gains for the investor to be disclosed. And similarly for the annual return that the investors file. So that's all. So that's all I had from my side. I'll be happy to take any questions.
Wonderful presentation, Sunil. Umesh, you are there? Umesh, you wanted to say something? Anil? Anirudh?
There are
Anirudh,
some
you are
comments
there?
in the chat. I don't
I'm
know.
there, sir.
Yeah, can you put your video on and share a few thoughts about share something about yourself, and also would like you to share a few thoughts on the current developments in the markets, particularly last week. There have been a lot of developments and how investors are taking it, and also some opportunities.
Sir, basically, like, I'm basically a MBA finance. I have been in the markets for over 15 plus years. So, including stints overseas. So, I understand the overseas investing process, how they think, how institutions operate overseas also. Now, the current point is that in current situation, it's a commodity price inflation. All of us have to live with that. That's a risk. We had a call at PL also with Vikram today. So what he said was that it's a good event, good thing, but then it's a situation whereby we don't have to rush on Monday and buy all that is recommended. We need to buy gradually. That's like 100 रुपए अगर आप डाल रहे हैं portfolio का, तो 100 रुपए whether it's 100 crores or a crore or it's 100 rupees. The idea is you add 1 or 2 rupees, 5 rupees in my opinion at a time across a basket. So that's how I think things will evolve. Basic framework, I think anything all of us can ensure is balance sheets are stable and demand is basically strong. That is what leads to multi-baggers or any other kind of structure. But generally said, 5 साल के हिसाब से देखिए, साल 2 साल 3 साल के हिसाब से सोचना नहीं रहेगा इस पर. Nothing less than 5 years. So if somebody is saying less than 5 years, we say, sir, abhi badda.
So Anirudh, what do you look at? You look at investing through mutual funds or PMS structures or direct investing?
Everything, sir, depends on your comfort or somebody's comfort as a client. So some people are more comfortable with equity, some people are more comfortable with mutual funds. So we don't have a problem in terms of offering any choice. We are offering a proposition which is best of both worlds. We try to follow the rules of leverage in terms of not try to use it in shallow markets and try to use it in when momentum is high. But then the idea is at this stage, our norms are quite stringent, both at PL and at our end. So that's how things are. So as it is, things are okay. But then abhi theek hai, war scene hai. So I think it's somebody for the US and once US and Russia decides, I think all of us are okay. Otherwise क्या है कि जो $2 trillion का है, war at capacity with Europe and the rest of the world, I think could be another $1 trillion or so at a minimum. You will see $10 billion worth of armaments are sufficient to destroy the entire planet if left to these people. So लेकिन हम कुछ कर नहीं सकते, it's out of our control. So let us see. Things are not so easy, but then it's not easy for all industries. If we keep a reasonable and a conservative view, we are okay. Debt में पैसा डालना है, there is no problem.
So interesting. Anybody else would like to share some thoughts?
So Manoj, I had invited two veterans who are veteran investors in the capital market. So one is Hemant Mehta. I'll ask him if he's still around to share how he looks at current situation.
Yeah, certainly.
Hemant, are you there? Yeah, he's unmuted.
Yeah, I'm there.
Just put on your video. Yeah.
Yeah. So broadly agree that in the current scenario, the pain is going to last for a little more longer time, and investing very piecemeal is the right approach. But frankly, you have to also go on monitoring your portfolio regularly, because given that time frame, like what things will evolve when is very fluid. So, for example, the previous person just mentioned that for a span of 5 years. Now, 5 years is a very long time. So, you have to go on monitoring, and then at times even take this thing about cutting out on your losses, if at all. So that is a little risky. That is something where people are not very comfortable with, but that should be the need of the hour.
Yeah,
Hemant, I'll respond to what you said. I think there was another person also who is speaking, right?
Yeah. So the previous person, I don't recollect his name, sorry, but so he mentioned that we have to look at the time frame of 5 years, which in a way is correct. But within this period of 5 years, you just go on monitoring your portfolio. It's not like the way things were before, that you just buy and forget.
So
Well, I would like to add, particularly on what you said, looking at a deep dive into what is happening. We talked about geopolitical issues, Russia, Ukraine, etc. So some top CEOs and bureaucrats came from Davos recently. They interacted with me just a few days back. And the thought process was this geopolitical supply chain sanctions, all these issues are there. But the real spotlight as of now is India. There are lot of expectations from India. Today, we are the fastest growing economy in the world. Last year and this year also, all the targets have been updated by IMF. And India is at the top of the list in terms of growth. And as far as the Western world is concerned, although their numbers like US is 1.7% growth, but there are many states. US is aggregation of states, right? There are many states in US which are at zero level, or there is a talk on recession. Another thing is looking at a deep dive into it. Everybody is talking about inflation, 7%, 8%. CPI, WPI, and often going up to 15%. And then they are saying now official inflation rate in US 8%, and interest rates have been much low. They went to negative. Now they are slowly going to 3.5%. But looking at deep dive into inflation, what people are missing out, where is inflation coming from? One is the crude and gas prices, which is totally by government policy action. Mainly it is government policy, artificial barriers, artificial sanctions are there. Today they are lifted, then apparently they would normalize to maybe $100 or maybe even below 100. Ultimately they will go down. Second thing is corn prices. Now corn is an essential component in some US diet. Corn prices are over 30%, but then world is affected by corn. Another thing is wheat prices. US, you have all these things about McDonald's and all this other things which go on wheat and wheat derivatives. So that wheat prices are over 30%. Corn prices are gone up. Crude prices are gone up. So it is a limited inflation in some particular areas. Steel price went up mainly due to supply chain factors in China. Now also we know steel prices have come down internationally over 15%. So these are looking at a deep dive. There are lots of anomalies.
Yeah.
So often fund managers, when they go wrong, most of the fund managers, they want to avoid redemption. Of course, they are supposed to give guidance on which asset class one should go into. Whether it is a mutual fund or a AIF, there are many asset classes, equities, debt, gilt funds, hybrid funds, right? And multiple options, including ETFs, including gold. But then it is very easy to say when you go wrong or when you see little fog ahead of your, so then one doesn't say it is not 5 years. That means anybody can't make a prediction or not able to make a commitment. So one should be very clear. If you have money which is available for 1 year or 6 months, one should be able to take a call on where to put. And there are many options available when you do deep dive. And people are talking what has happened now. Last week, there is a talk of capitulation. You know, there are a lot of carry trades. People leverage and they invest. And then the margin calls are triggered and those a sell-off happens. Sometimes sell-off happens for 2 days, 3 days, and then it bounces back. Now, what has happened last week is a consistent fall in the US market, Nasdaq and Dow, which often in other countries it has happened. Like Nifty has also gone down in the last few days, 5 days, and now it stabilizes for 1 or 2 days. But this is based on, we know about the interest rates. FOMC has already said the path for the next 2 years, the rates. And this hype about inflation which is coming. Another reason is there is a lot of travel, and that is pent up demand. 2 years people have not been able to travel. So they want to travel. So airlines are full and hotels, they were bleeding actually. Many had to close down. Now they are able to recover a part of their losses by increase in room rates or increase in airline thing, because they have not been able to make money in the first year, so they were in deep losses of pandemic. So certain areas, but when you see people flying all over the world today, and the rushes, whether in Boston, as was in a tweet by a son of a high-flying banker, or also in India, people are traveling across all over. So nobody sees any slowdown. Forget recession. Nobody sees any slowdown. You go to any supermarket or your sales which are done on e-commerce platforms. So they are all doing bumper and they are showing good growth. So this could be an opportunity, a huge opportunity, not only for long term. A long term, Lord Maynard Keynes said something about long term, right? Everybody is dead. So also on the medium term and short term. Of course, now Sunil talked about taxation of short term and long term both. So you pay lesser tax, 15%. Also, and you can make good returns because the way stocks have come down. Some of the blue chips, you look at the aggregates, your Nifty at 19 times when what you are getting in FD today, 4%, less than 4% in your savings account, and in your FD you are getting about 5.5, 6%, and even in the debt market you are getting maybe 8%, 8.5%, and taxable. So post tax is very quite low. And on equity over over a 1 year period, if one does deep dive, it could be a big opportunity. The point is only those who are into leveraged trading in the last few weeks and months have taken a beating. But then, as people say, some call it a correction in the bull market, some call it a bear market. Depends on the way you define which indice. If it has fallen 20%, some definition. But some people say it started on 3rd of January. So we already 6 months in the system. And normally such corrections and bear markets historically are between 4 to 9 months. So even if it is there, we have spent a long time, and the bounce backs and pullbacks, when it happens after a fall, they can be big and brutal, and the bears run for cover.
Yeah, agree.
Anybody else would like to share some thoughts or any question? Everybody is welcome. Any sector, any country, any commodity, any whether it is any asset class. Anirudh?
Well, not at this stage. I think it is. It's a phase of wait and watch, sir. Specific stocks ka we'll do the quarter 4 discussion. Compare kar lenge PL and others. So that will give an idea.
Sorry, what did you say? Which stocks?
I still have to do that exercise of comparison for PL as well as for the Motilal thing, which we had discussed for next week. So uska main comparison kar leta hu ek baar. Comparison rather than understanding. We don't do comparison. We generally like to
put on a
understand.
video. Anirudh, put on a video. Video is on?
No, the video is not.
Just put your video on. Yeah. Now, this is the time actually to look at a deep dive into sectors and churns are happening. Stocks where money is flowing in, or somehow the business houses, whether mutual funds or PMS, they suggest some sectors and some stocks, and often they have certain model portfolios, their own, based on research. So there was a suggestion to look at model portfolios of various houses and compare them and see what are the trends. So it is really great. Some of the speakers are suggested to take up in a part of a series and to look at the portfolios of different entities. So this is a great opportunity to look at it. And I'm sure Anirudh, later when your study is there on a week-to-week basis, and then not only share what model portfolios they are looking at, but how they are performing also on a month-to-month basis, a quarter-to-quarter basis, a half-yearly, annual basis, and which are the best performers. We will also come to know what type of decisions they are making during the transition, and also changes in model portfolios. So after 1 year, we can see who was right or who performed well. It is not only the numbers, but also the risk-adjusted returns.
Yes, sir.
That also we can look at a deep dive. So we'll
Surely,
have that very, very soon. Yes. Anybody else? Any questions? We'll answer everything. We'll answer. Sunil is here. Anirudh is here. All questions will be answered by them. Anil, you are there? You wanted to say something? Sunil?
Yeah. Nothing from my side. So I think if there are no questions on my session, we can close up my session.
On your video.
Yeah, I think looks like there are no further questions on my session, so we can conclude mine.
A wonderful presentation, deep dive, comparative tables, and this is one of a series of presentations. Taxation season is also started on. So we look forward to a series of presentations also on return filing and the key aspects to look at it soon before the deadlines are out. and how people can do some tax planning and take benefits, and some new changes and portals are coming. And with this, yes, a wonderful season. Let's wish all the best and recovery from the current crisis much fast, and peace be restored soon on the global level. So thank you very much.
Thank you, everyone.